Hello friends, today we will discuss Sysco Corporation. Sysco Corporation is a global leader in marketing and distributing food products to restaurants, healthcare and educational institutions, hotels, motels, and other food service and hospitality businesses. They market their own Sysco brands, as well as major national, regional, and ethnic brands, along with local products. They operate in 90 countries and have a wide range of products from basic to rare and imported gourmet items. Let's move on to the company's financial indicators. It can be seen that the company's revenues are steadily increasing, but the net profit is not as straightforward. The company has assets that barely exceed liabilities. Additionally, the company is gradually buying back its shares from the stock market. My final rating is 6 out of 10. The company has approximately 600,000 clients in the US, Canada, and worldwide. The company has several powerful own brands that are an integral part of every restaurant, and Sysco is a unique monopoly in distribution, although the company only owns about 30% of the market, as the industry is highly competitive with a large number of unknown small businesses. However, the company is not considered a monopoly. Unfortunately, these are the only positives for the company. The issue is that the company cannot have significant growth potential due to its drawbacks. Firstly, the company depends on suppliers of the products it sells and promotes under the Sysco brand, meaning that if third parties fail to meet their obligations regarding the quantity and quality of goods received by Sysco, the company may face supply problems or loss of reputation as a reliable supplier. Secondly, every business only thinks about its own growth, and if manufacturers face problems such as crop failure or drought and have to cease operations, it will also negatively affect the company. Due to these two factors, the company has limited growth potential because even if it has a powerful brand and market leadership, if it creates a situation where demand exceeds supply through advertising, it will face the aforementioned two problems. The company has already started investing in its own production facilities and developing its own brands, but I remind you that the company occupies more than 30% of the distribution market, which means that the company will need to have 30% of the entire agricultural sector to become independent, which is impossible even for Sysco. Therefore, the reality is that the company's main business is and remains marketing and delivering quality products. Thirdly, when you are a giant and operate in 90 countries and have 600,000 clients, it is simply impossible to effectively manage thousands of businesses that you own. The company will have to make significant efforts to correct this situation, which has also led to the fact that although the company's revenues increased from 2009 to 2016 by almost half, net profits decreased to almost $600 million. In other words, the company was acquiring businesses to expand its global reach even if it did not generate profits. My assumption is that this was done to increase sales of Sysco's own brands and simply to transfer customers to its product network. This is why from 2009 to 2016 the company's revenues increased while net profits decreased. However, now we can see that this type of investment was the right strategy, as after 2016 when the company took on debt and began cost restructuring, you can see that the company started steadily increasing net profits. Today, this stock can be purchased for approximately $76, and its market capitalization is approximately $38 billion. Personally, I estimate the company to be worth around $27 to $31 billion, meaning the company is trading more than 25% higher than my valuation. My buying price range for this company's shares is around $55 to $65, and I believe we may soon see these prices, as the business has too many risks. Just consider one factor, the price of gasoline alone, which already significantly impacts the company because if prices are high, it will increase the prices of the products Sysco purchases, and the company will be forced to raise delivery prices to its customers, and all these costs will be passed on to them. If I were a restaurant owner, I would at least consider alternatives or simply start raising prices on my products to customers, which could lead to a loss of customers, and in that case, I would reduce costs because if there are no customers, there is no point in purchasing large quantities of products, and that is why, in my opinion, it is not yet time to buy Sysco. I personally will wait for a price of $55 per share and allocate no more than 1% of my portfolio because I know companies with much greater potential. Subscribe to my channel to not miss my future videos.